Good afternoon, everybody, and welcome to another edition of Between the Lines Live. Actually, it's the first one for 2025, so welcome everyone. Happy New Year. My name is Vanessa Rader. I'm the Head of Research at Ray White, and today I am joined by a panel of experts to talk about all things commercial property and 2025 in particular. So we're joined with Peter Vines. Pete is the Managing Director of RWC Western Sydney, and he's been on the show many times before, so thank you very much, Pete.
Thank you.
And Domenic Lo Surdo, and he is the Executive Chairman at Stamford Capital. So we're really pleased to have Dom here,
Thanks,
our external speaker, to talk finance in particular and also the commercial market. So before we kind of get started, I might just pass to you, Dom. Can you tell us a little bit about what Stamford Capital does and your relationship with our business? And yeah.
Absolutely. So Stamford Capital is the largest commercial mortgage origination business in the country. Got offices across the country. Should settle about $3 billion this year, all in commercial real estate. So everything we do is in commercial mortgages. We don't do home loans or any other type of finance. Yep. We also have another division of the business which invests equity alongside our clients in joint ventures.
Yeah. Certainly interesting time for that part of the business, and we'll definitely be talking about that a little bit more. I might just start with a bit of a kind of a thought of, we wrapped up 2024, was a pretty kind of tough year, is the best way to probably put it, for the commercial property market. We saw volumes come back a little bit, but we did see a bit of a flurry of activity towards the end of the year, a bit more confidence coming to the market, a few institutions actually having to bite the bullet and sell some assets, which is a good news story. Some change in terms of where the yields are sitting. Again, good news story for that. We saw the private investors very much take a forward leap and really go forward in purchasing these assets. Again, great news story for 2025. So did you see the same sort of thing in 2024? What's your 2-second synopsis of 2024?
Everybody was very happy to see the back end of 2024. Yes. I think the cause of transactions toward the end were people probably who were just sick of holding on, not doing anything, who just wanted to dump it and wanted to get going. It was an interesting
term, wanting to dump it.
It is a technical term.
Right.
It's one we use quite heavily. It was a challenging year. I mean, there was always pockets of light. There always is in any market, but certainly just more difficult to get things done, harder to recognise value. And then I know that there was a lot of people who were very fatigued by the end of last year and were just like, get me out of here. So
we're back here, ready to start again. And how was your end of last year?
The capital markets were really interesting last year. Certainly the debt capital markets, where obviously we play, were very active and full of liquidity. And in some respects, I think, helped stabilise perhaps some downward pressure in markets. We saw a number of new entrants come to market. We saw increased liquidity in markets, which drove pricing of credit down, certainly for those projects that stacked up and hit the financial targets that projects need to be financed. So it was interesting to hear your comments, because we actually had a really good year. Last year we were very, very active in what was a tough market at a real estate level, and I think part of that was refinancing some existing assets that people had. Looking forward to the year ahead now.
Yeah, so let's look forward. Let's look at 2025. And I feel like the last couple of years, I don't want to say kind of kick the can down the road, but I really do feel like that's another technical term we could throw in there.
Yeah.
I feel like a lot of commercial owners really have been holding on, reluctant to do a deal. Like, we did see a few deals, but that pricing piece has been hard for a lot of people to kind of swallow.
Yeah.
But I feel like we're getting to a point where some of these transactions are needing to be done.
Yeah.
Where there's been some price adjustment to make it look like it's kind of probably the time for that to happen.
Yeah.
Do you think that's a pretty fair assessment?
Yeah, absolutely. I mean, what it required to start with was valuations changing and resetting benchmarks, because obviously, particularly in the institutional space, trying to do things below vals when you've got investors who are sitting there, watching money carefully, is very difficult. When the market resets and the values are there, people can move forward. And I think that's, people want to be transacting, they want to be buying, they want to be selling, but it is more difficult when there's perhaps not the visibility on where yields might be, or where they should be, until you have some of those transactions. Again, that's particularly with investment. Development in a lot of sectors is still, pretty tricky, as we've talked about previously. but yeah, it will be interesting to see that space this year.
Yeah, I think we should talk about the development site market. To be honest, we really haven't spoken about it much on these webinars the last couple of years, just because the volume of transactions have been so limited.
Yeah.
Obviously, that segment of the market has been roadblocked by so many things in terms of the cost of construction, the cost and lack of labour.
Yes.
However, we're in a situation where population growth has been strong, particularly out in Western Sydney, which is obviously
Huge.
the area that you guys focus on.
Yep.
So we're in a housing stress. We've seen rents go up. We've seen all these, the values of median prices go up across most markets. So what's going to happen? Like, this development site piece has got to change. You look at it like, I'm going straight to Dom here. He's got more positivity in his eyes.
Yeah.
Look, the development market's hard. I think that's a fair comment, in particular in Sydney. And your observation around construction cost escalation is really the material impact. What we were expecting to see last year was to see land values adjust downwards on those development sites. But we didn't really see it. We probably saw it towards the end of last year. Pete, maybe you can comment on that a little bit more.
Yeah.
We certainly saw a little bit of an uptick in some forced sales. And maybe that's the answer. Maybe the answer is, and certainly the logical answer when you're looking at a feasibility, is the land value should adjust down. But I think the market's well capitalised. Private investors have built up a lot of wealth over a number of years. And that sort of forced sales mentality that we're expecting to see didn't really materialise last year. Whether it comes this year or not, I'm not 100% sure. I think it will. I think there's an element of it, at least at the margin, where perhaps some borrowers and owners of those sites are overextended and maybe even getting a bit of pressure from their financiers to do something with those sites, including the sale of them. But it is hard. It's really hard. Finding labour's hard. Certainly in Sydney and Western Sydney. We've done some stuff in, I guess, pockets of Sydney where prices are higher and projects are stacking up on that basis. And other markets, South East Queensland's been really strong. And
well, they've taken all the labour, haven't they, up in South East Queensland?
They've taken all the labour, apart from that and the infrastructure that the governments are undertaking as well. But certainly there's that migration, positive migration story into South East Queensland, which is allowing that labour story to play out very differently to how it's playing out here. But again, pockets of that development market are active. South East Queensland is probably the one that sticks out more than others.
And how about, well, we're talking about pockets that are working. I suppose it's probably the size of the actual project is the key. When we're talking, maybe a Parramatta CBD type resi development that has, many layers of underground parking required and very high rise becomes not feasible.
It's cost prohibitive. It doesn't work in many instances. I think coming back to what Dom said, the liquidity in the market is really what has held. I wouldn't have say held values up. I would say has stopped transactions occurring, because you can see in where values should have come down, but they're simply not transacting, and nobody wants to realise a loss, but in many instances, unfortunately, what you paid for it, even 5-10 years ago in certain locations, unfortunately, that's just not where it is. And that's, the cost of construction has gone up exponentially. I'll tell you what hasn't gone up is the cost of units. Like, the price of the units that are selling hasn't really gone up at all. And so that is really problematic. Serviceability is still an issue. Delivering stock is an issue. And so I think where we have seen, multi-story, 3 levels of basement, trying to get people to look at it is challenging at the moment. Depending on where it is, I mean, if you're kind of above 14 grand, 15 grand a metre, it's still, those markets people will still look at depending on the supply. Good real estate is really good, and everything else is a bit more problematic. I think where there is good strength and where we're seeing a lot of demand from developers is housing stock. I know that you guys fund stuff out west, particularly in the subdivision and the townhouse space. They're selling really well. I heard that they had really good sellouts at Orchard Hills in their first stage. great projects. You know, they're just fundamentally very good projects, close to amenity, close to university. They're still really good. Your build costs aren't the same, you know, and that's a part of the market where people have more money. They're wanting to buy a home as opposed to a unit. But fundamentally, you know, we need more units. Like, it's not, unfortunately, you know, $1 million houses that's going to, you know, come to save the day. We need more apartments so that we can have more rental stock in the market. I don't quite know what the right answer is, but certainly values of the end product must go up. I don't see any other opportunity there. I think investors need to be stimulated to come back into the market. The returns should hopefully be better given where rents have gotten to.
Yes.
But the government needs to sort of incentivise that happening. You know, them delivering apartments, I don't personally believe is the right answer. I think participation with government and the private sector is really where, you know, innovation is found, and that is what will help us move forward in that housing crisis.
Okay, so there is a real size piece. So it's still the infill sort of stuff is doing okay because it's smaller in size.
Yeah, boutique.
Townhouse, boutique, or even that
It's
kind of
perfect.
luxury retail, or not luxury retail, the resi.
The
East Coast.
downsizer market and all, because they're the people who have discretionary spend. I mean, they sell their house for $50 or $100 million. You know, there's eye-watering, and then they buy a $10 million unit. How lovely! No, but there's a bit of margin in there to play with. But certainly the townhouse and the infill product, you cannot find it.
No.
You know, so it's sort of that's what developers want. They want a product where they can create a difference.
Yeah.
You know, when Chatswood, like, you've got these towers going up everywhere. How are you going to differentiate between your stock? So
So what's going to happen to those big sites that people have been holding on?
Well, I think the other issue is that, you know, there's much fewer developers who can deliver things at a cheaper rate. We've had the building commissioner, who I think is, you know, great, because we need to protect our consumer.
Yes.
Like, we need to protect our consumer. I'll say that again. But as a result of that, and as well as the government's, you know, never satisfied thirst for taxes.
Yes.
It just, you know, the cost just keeps going up, which is, again, it's, you know, it's a really sort of problematic thing. But there's far fewer builders.
Yeah.
You know, people are saying to me, we don't want to do residential anymore. Why would we want to do residential? You know, the tax that has to be held on the side for defects, and it sort of gets to the point where it's like, why are we going to build? Like, let's go and do industrial. Let's go do, you know, retail. Do anything but residential.
Yeah, and we have seen all those builders collapse over the last few years, and so the pool of builders that have the capacity, not even capacity, have the ability to build those big high-rise apartment buildings. There's so few of them, and like you said, that doesn't seem to be attractive when you can look at industrial or something, which is a far kind of more attractive thing at this point of the market.
Quicker turnover, good demand.
How about, there's been a lot of talk about build to rent. We had some of the guys in your office actually, Pete, come and talk about build to rent last year.
And Bennett,
So there's a lot of kind of noise, and I say noise, around the build to rent market. Thoughts? There's a lot of offshore capital. This is the other piece as well we haven't spoken about. There's obviously a lot of things going on overseas at the moment. The dollar is
Don't
looking at.
That. I thought we weren't going to talk about it.
The dollar. I didn't mention it.
No.
The dollar is attractive.
The dollar's very
attractive for offshore investment into Australia. We know that there was a Korean pension fund, a market that's never really been strong in Australia, looking to disperse some funds and looking in particular build to rent space. There is some tax advantage for those funds to come over here. Do you think?
Not in Melbourne.
No, well, let's just not talk about Melbourne.
No.
So do you think that? But again, I don't think that they can stack up. It doesn't matter that it's build to rent, but
it's certainly an institutional asset class.
Yes, of course.
So it's not mid-market private. As a general comment, I do think it has a place in the economy, and it's an important part of attempting to solve the housing problem. It's not the solution. I think the government needs to mobilise the mid-market. I mean, if you think about the scale of the mid-market and the capacity of the mid-market to deliver residential product relative to the scale of the institutional market, it's 10, 20 times bigger if it's mobilised properly. And so we're big advocates for mobilising the mid-market. We think that is the solution, not necessarily build-to-rent sector. But look, there will be space for it. There will be places where it works. I mean, listen, the financials just don't make sense from a mid-market mindset, but institutions look at these asset classes over long periods of time, and I think are making sort of a valid case for investment on that longer term investment horizon.
And particularly these offshore funds that have experience in other places of the world where it's obviously a very sophisticated asset class, and we're just we're very green here, and it seems a bit kind of foreign to us.
I think I think it has to be part of the market. I don't think it's the only solution. It has to be part of the market in the future. I mean, I personally believe that there will be a lot of people who have, unfortunately, fortunately or unfortunately, will never own a property. May not have an interest in owning a property. It may not be everybody's dream anymore. I mean, it always was the Australian dream. But maybe the dream's changed, or it's evolved, or it's, whatever it is, pivoted. Where it's a lifestyle thing as opposed to I must own real estate. And so where do those people live? You get moved out of a rental every 6 months.
You want
in
the
Europe,
certainty.
you want the certainty. You want, and probably I dare say the government wants some sort of control without controlling it completely. How far you can push rents and that, like some sort of control over that as well, long term. So if you're dealing with fewer players, more institutional grade owners, there has to be a place for it. But it just there's a lot of properties earmarked for it. I really hope they all get out of the ground.
Let's talk a little bit about industrial. You did mention it, because industrial development seems kind of a bit, it's feasible in this current environment. Very different asset to construct, as we all know. We know industrial has certainly been the asset class of favour for the last 5, 6, 7, 10 years even. We've had it's a market that's very constrained, as we know. There isn't a whole lot of land supply available in all states. Some states there's more than others. Vacancy is very low. Our requirement for industrial continues to be there. Albeit there's been a bit of shift in more recent times. We've seen a bit more vacancy kind of growing in some markets more recently. A market that's really benefited from rental growth over the last couple of years. We've seen the private investor market, the owner-occupier market even jump into that space. Do you think that there isn't a whole lot of new supply? We do have some, we can talk about land and the serviceability of land, particularly for industrial, but are we going to see a bit more construction happening this year, you think?
I'll just talk about what I'm seeing then, Dom. I know that Dom's seeing it from the borrowers who are coming through their side as well. I think, look, there's a real weight of institutional capital that loves to play in that space, and it's like a long-term view, and the demand on kind of data center space and warehouse space is only going to continue to grow. We're only at the beginning of what we're seeing, particularly with the rise of AI and stuff. It's going to be enormous. There's still a little bit of an issue, I think, between stacking certain developments up just because of the cost in servicing land. So I think there will be a real desire to sort of that last mile type stuff, infill locations. People will pay a higher price for them because the servicing's in, the market's there. There is a fixed amount of land, and so I don't think things will come off. I think the onslaught of demand that we saw coming out the back end of COVID, I think that's kind of settled. I don't think there's any question about that. There's a bit more subleasing coming up. It's slightly, more difficult. But again, good real estate is really good real estate, and everything else is a bit more difficult. That's in the institute. In the private space, I think that the owner occupiers are still strong. The investors will come back into the market, but are being completely outdone by owner occupiers at the moment. Can't compete. And so but in the smaller space, the strata kind of industrial, it's just a little bit more challenging because some of those businesses are a little bit, not quite sure what's happening. They're not rushing out to go and buy a new property. They're wondering how their business will go kind of this year and into the future. So still a great market though, and
still one of the
plenty of demand. Oh yeah, absolutely.
And do you deal much with those kind of owner occupiers that have been really competing for industrial stock? It's around the country. This is not just a Sydney story. Yeah,
we do a lot, and I think you're right. The industrial sector's been very well supported through both the debt and the equity markets over the last few years. I don't see that abating in the sense that I think there's still, if you were to ask those investors and the capital markets, the debt capital markets in particular, what are the asset classes that you'd be most supportive of banking, and industrial would be right up there.
Yeah.
Absolutely.
So that sort of concern around the capital markets shifting away from industrial, I don't necessarily share that view, but I do feel we are feeling some downward pressure on rents. The investor market's probably, you're right, it's invariably outbid by either institutions or owner occupiers. That's where we have seen that directly. But fundamentally, I think the capital market's there to do those deals.
It's got a really good long-term story still to play out.
The tailwind story.
Yeah.
And it's funny because the industrial markets, when I was in banking 20 years ago,
that was a dirty asset you didn't touch.
no one wanted to do it, you know.
Yeah. Were you getting a 12% return?
Yeah.
You know, like
you still couldn't
12%. Yeah. You know,
there's a real shift.
Yeah.
And I think it's permanent. I actually think that.
Well, there's been structural changes in the market that mean that it is,
it's a far more
particularly with the
sophisticated
delivery and the demand for online, like, you know, it just is.
It's a far more sophisticated asset class than it ever was before.
Far more.
And particularly if you look at the data center story as well, like our requirement for data centers is only going to continue to increase. And it's
we're going to have a power problem.
We're going to have a power. I was going to say, but the problem is
we
the
can
power.
only ride bikes so much.
The power and the water for cooling and stuff like
Absolutely.
that. So where do you locate these assets? You can't go stick them in the middle of the country
well,
because it's far too hot.
They have to be close to
and
the other ones.
And the connectivity as well.
Connectivity with the other
and then
nodes
security. There's so much around it to really unpack. And where we're still in the early stages, but it's definitely going to be a growing feature of our industrial asset class going forward.
Yes.
I just want to touch on something that you said about private credit and feeling confident about the industrial market. Can I hesitate to really ask you where we're not feeling so confident with where some of that money has been going?
In the private credit space in particular? Yeah, look, as I sort of touched on in my opening remarks, we've seen this extraordinary growth in private credit, well documented. I mean, you can't open a newspaper without reading some story about private credit. And I've never seen liquidity in the credit markets in my entire career as strong as it's been the last couple of years. I do feel, though, that we're kind of getting to the end of that cycle, and I do think the private credit market is going to go through a period of, let's call it recalibration. We certainly saw some headline stories over the Christmas period from a number of private credit non-bank lenders where they're having to deal with defaults in their books, and that's new, and that obviously needs to wash out with their investors, and how that gets dealt with by their investors in terms of their appetite for that particular asset class remains to be seen, but I do feel like there'll be a pullback. Whether that means, we saw pricing in non-bank credit effectively at bank levels, which was crazy. You can't have non-bank pricing at bank pricing with significantly higher risk, whether it's additional pre-sales or additional leverage. That just doesn't make rational sense. So I do feel like this next 12 months is going to be a really interesting period in the private credit markets. I feel like we're going to see certainly some recalibration. As I said, I think we'll see some either pricing go out or appetite in terms of leverage in that private credit market probably come back a little bit. How that impacts on underlying real estate markets, we'll have to wait and see. But I feel like we're at that point in the cycle where we went through this level of exuberance, like all market cycles, and it's probably going to come off a little bit over the next 12, 24 months.
Yeah. It feels like people aren't sure where their exit is now, or when their exit is. And so I think that kind of gets people going, well, we're not so sure anymore about what's happening.
Yeah, particularly where there hasn't been a volume of underlying transactions to support the valuations that these deals have been written on. So
they're old vows,
new market, and so I just feel like there'll be a little bit of a pause and a bit of time for introspection from a number of the private credit providers.
I reckon I think there's going to be pressure on
distress.
I think there'll be a bit, absolutely. I'm surprised we haven't seen more, to be perfectly frank, and I think that again comes back to this, abundance of credit.
And holding on.
And holding on, and look. If you're a developer or a property person, you've got to be optimistic. You've got to want to, you hold on to the last minute.
Yes.
But surely there comes a point where it actually doesn't make sense anymore. It just to keep certain assets. You're far better to just cut deep, cut quick,
Yeah.
and let it go, and try and retain what you can, which is, you know, perhaps better quality, but just, you know, sometimes, and it's very, it's easy for me to say that, just sell it.
Yeah.
You know, that's my advice, sell it. No,
Yes.
it's not always my advice, but I think certainly we'll see more pressure, and I think that it's come to a point now where people will say, sorry, you've had your time, you can't refinance, you need to transact now.
Yeah, and part of that holding on period was actually driven by the liquidity in the credit markets, insofar as there was always another non-bank lender to refinance the outgoing non-bank lender.
Yes. Yeah.
Whereas I do feel like we're at a junction now where that new non-bank lender's not necessarily got the same.
They're not there at the same
They
level.
haven't got the same appetite.
And they don't have the same valuation anymore.
The valuations change.
So you need to give us a bit more equity in the...
Yeah, and that pressure will be applied at an asset level.
Has to be.
And whether that's through informal or potentially some formal appointments, and we've certainly seen an uptick of some formal appointments over the last 3 or 4 months.
Yep.
Probably expect that to continue through this year as well. I don't know what your thoughts
Well,
are on that.
I completely agree. What's good is that there's still a lot of privates out there, and I'm just talking about sort of some of the developers. There's still a lot of privates out there with money who have been sitting there waiting for this opportunity, and so we're still getting good interest. We're still getting strong results on certain assets. Again, the good stuff is good.
That's right.
You know, and we'll sell it, and you'll get a good price. The moment it's got hairs on it, or it's more challenging, or whatever, it's far more difficult because people don't have that eternal optimism at the moment.
Yeah, that maybe was here during that kind of COVID period.
Absolutely,
when people were
when you
investing.
buy anything.
I think the other thing we've seen is that at that sort of institutional level, we've seen boards give pretty clear instructions to businesses to sell assets, and there's been some press around that over the Christmas period as well, and I expect that probably continues to evolve over this year, and that'll create great opportunity for private investors. I think where as an equity investor, I mean, with some of our clients, we're sort of getting a little bit excited about that. We think there'll be some great buying opportunities out of that institutional market in particular, as assets that are historically hard to get your hands on come to market.
But I think now is that time though, because I think once the rates start coming off, more people start coming back in. It's really that void in the market where it's hard to see value, but there's that window, and that's potentially that flurry of buying at the end of last year was really, when there's talk of interest rates dropping, that will naturally bring people back into the market. And I think the best time to buy is when others
aren't buying.
Others aren't buying. Others aren't buying. It's a perfect time, but you've got to really have big conviction.
Yes.
Yeah,
Big
and I
conviction.
think those as to your point,
technical
those buyers are invariably well capitalised, right? The private markets in particular sitting on significant amount of capital.
Well, I wanted to say what was, because we were already actually out of time, so we haven't even touched a whole bunch of asset classes we wanted to talk about. So we're going to have to get you both back in a couple of months' time. Part two, I think, is definitely on the cards. I was going to say, so what are the opportunities? But I think kind of you've mentioned them, like buying those assets that, like you said, that otherwise wouldn't be coming to market. And is there an asset class, or industrial you did touch on, is that if you had your money to plant somewhere, is industrial the place to be? Or
I like industrial, I like retail.
Retail?
Yeah, I like retail as an asset class. And defensive retail in particular.
Yes.
Not fast fashion.
Not preferably not.
Yeah.
Food, fuel, we're still
Yeah.
sort of supporting clients, and capital markets are very supportive of clients in those sectors.
The yields are still very tight.
Unbelievably
Even on
strong.
childcare and all of that
Childcare.
stuff. It's very strong.
But again, location sensitive, good real estate is good real estate.
Good real estate's good real estate. And there's good deals in any market. You just have to
there's
look
opportunities
for it.
there.
There's opportunities. There absolutely is. You just have to, I'm a big fan of not building ground up. I like refurbishment. I like tweaking. I like, buying retail where there's, you can add value, reposition tenants. Like the development thing at the moment, maybe future development, but you have to be taking a much stronger yield on the way through.
Yes.
Because it just, when is development right, perhaps still not that apparent in certain locations.
Yeah, I've written a piece that's coming out next week, but it's on more the office market, which we have not touched on at all, which was probably not a bad thing. But on the refurbished space there, is there an opportunity in that part of the market? Because it certainly doesn't stack up to be building
New.
Yeah. Yeah.
Nor is there demand for it, to be completely honest.
But I think there's developers now who are saying now's the time for us to start looking at office because you can't build new stock, because we believe that there'll be this uptick, and then hopefully, it is the right time. But
and we've got all this offshore money coming, like,
Yeah.
so if you want to buy a trophy asset, well,
Yeah.
now's the time to really
Absolutely.
be jumping
Never
in and getting
been a better time.
that market. But anyway, we are out of time, and I'm so sorry, but I think we need to 100% do a part 2. So thank you so much to Dom and Pete for being here and talking to us about where we think 2025 is going to go for these kind of parts of the market. Would love to have you back next month. I think we'll be talking about retail a little bit more next month, and so please make sure you jump on YouTube and share this with your friends and anyone in your work circles. Would also be on Spotify as always. I hope you guys listen to the podcast on Spotify.
Always.
And we'll see you next month. So thanks again, guys, and see you soon.
Thanks, Vanessa.
Thanks, guys.